All right, let's dive in. Today, we're going to tackle a topic that can make even the sharpest managers a little nervous: business finance. We're going to break down the essentials so you can start speaking the language of business with total confidence. Let's get to it. So let me ask you this. Do you ever get that sinking feeling, deep in your stomach when your boss asks you to prepare a return on investment analysis? Or maybe when people start throwing around terms like sacrificing gross margin for revenue? Well, if that sounds familiar, I want you to know you are in very, very good company. 38%, you see that number? That was the average score a group of American managers got on a basic financial literacy quiz. Yeah, a failing grade. So if you've ever felt a little lost in these conversations, trust me, you are far from alone. But here's the really great news. Finance doesn't have to be scary, and you definitely don't need an MBA to get the fundamentals. Right here, right now, we're going to take a quick journey from financial fear to financial fluency. And let's be super clear about our goal here. The point is not to turn you into a CFO or some Wall Street wizard. Nope. It's to give you the confidence you need to master the basics, to really understand the story the numbers are telling, and to become an active, confident participant in the conversations that drive your business forward. So where do we even begin? We start with what I like to call a business's health report, the 3 key financial statements. These are the documents that executives, investors, you name it, they all use them to figure out what's really going on inside a company. Think of them like this. These 3 statements team up to tell a company's complete financial story. You've got the balance sheet, which shows what a company owns and what it owes. Then there's the income statement, which tells you if it's actually profitable. And finally, the cash flow statement, which, you guessed it, tracks the actual cash. Let's break down what each one really does. Okay, first up, the balance sheet. The absolute easiest way to think about this is as a financial photograph. It's a snapshot of the company on one specific day. It tells you in that single moment, here's everything we own, our assets, and here's everything we owe to other people, our liabilities. And it's all built on one simple but powerful equation: assets equal liabilities plus owner's equity. Now, owner's equity is just what's left over for the owners after all the debts are paid. And the reason it's called a balance sheet is because both sides of this equation must always, and I mean always, balance out. Next, we have the income statement. You've probably heard this called the P&L, which just stands for profit and loss. Now, if the balance sheet is a photo, the income statement is a video. It shows you the company's performance over a stretch of time, like a quarter or a whole year. And it answers that huge question: did we actually make any money? And getting to that famous bottom line is all about another pretty simple equation. You just take all the money you brought in from sales, that's your revenues, and you subtract all the costs of doing business, your expenses. And whatever's left, that's your net income. That's your profit. And that brings us to our third and final document, the cash flow statement. I like to think of this one as the detective. It follows the money, it tracks where cash actually came from and where it actually went. It tells the incredibly important story of how, or if, that profit we just talked about turned into real, spendable cash in the bank. And this idea, it is so important, it's getting its own section. Because understanding this is the key to avoiding the most common and the most dangerous trap in business: the profit versus cash misconception. This is the one thing that can sink even companies that look super profitable on paper. Okay, you ready? Here it is. This is the single most important secret you need to know. Profit is not the same as cash. See, a sale gets recorded as revenue the second you deliver the product, which creates a profit on paper. But you don't actually have the cash until the customer pays you. And that timing difference, that gap, can make or break a business. Let's look at a perfect example of this paradox. We've got 2 businesses. On one hand, Sweet Dreams Bakery. It's profitable, but it's got a cash flow nightmare. It pays its suppliers in 30 days, but its customers take 60 days to pay them. On the other hand, we have Fine Cigar Shops. It's actually losing money, but it's swimming in cash because customers pay right away, and it takes 60 days to pay its suppliers. So, which company do you think is in more immediate danger? Let's zoom in on that profitable bakery. So in February, they make a $2,000 profit. Sounds great, right? But look at their cash. They're $22,000 in the hole because they've already paid for flour and sugar, but they're still waiting for their customers to pay up. Then March is even better. They make an $8,000 profit, but their cash problem gets even worse. They are literally growing themselves straight into bankruptcy. Okay,
So, understanding these statements is step one. But the real power, the real magic, happens when you can translate this knowledge into action. It's all about knowing which levers you and your team can actually pull every single day to improve the company's financial health.
And this is so important for your career. I love this quote from the HBR guide. It says, "Every business runs on financial data. If you don't know the tools, you'll be left out of the larger conversation." See, this isn't just for the finance nerds. It's essential for any manager who wants to have a real impact. So let's look at one of those tools right now. It's a simple little ratio called return on sales, or ROS. Now, don't worry about the formula. Just focus on the really powerful question it answers, which is, for every single dollar of sales we bring in, how many cents are actually left over as profit? It's a key measure of how efficiently the whole operation is running. So what does this actually mean for your team? How can you help improve that ROS number? Well, if you're in sales, it's about not just hitting revenue goals, but thinking about profit, maybe avoiding those super deep discounts. For marketing, it means measuring the real bottom line impact of your campaigns to get more bang for your buck. If you're in operations, you can streamline processes to lower the cost of making your product. And if you're in product development, you can design new products that have healthy profit margins baked in from the very beginning. You see, everyone can pull a lever. You now have the building blocks, you can understand your company's financial story, and you can speak the language of business. So that leaves us with one final, powerful question to think about. Armed with this new knowledge, how are you going to change the conversation with your team tomorrow?